Welcome to the last panel of the day before we welcome the Prime Minister. We've got an hour together this afternoon, and we've got a lot of ground to cover as we get to grips with the key risks and trends and developments for Australian business in Asia. But let me first introduce our panellists. Swati Dave, on my immediate left here, is the CEO of Export Finance and Insurance Corp, the government's export credit agency that helps Australia win and finance export investment opportunities. Swati has over 30 years banking and finance experience across sectors including infrastructure, energy, utilities, renewable energy and property, and she's held senior positions at National Australia Bank, Deutsche Bank and Westpac. She's also led businesses in Australia, the UK, Hong Kong and Singapore. Next we have Mark Whelan. He's the head of ANZ Bank's global institutional business across 15 Asian markets, as well as PNG, Europe, America and the Middle East. He's also an almost 30-year veteran of the banking industry. He joined ANZ in 2004, has held a variety of senior roles, including Australia CEO, MD of Corporate and Commercial Banking in Australia, and head of the institutional, commercial and private bank business based in Hong Kong. ANZ is the most Asia-focused of the big four Australian banks and has been in the region for 40 years. Martin Tricot has been the CEO of HSBC Australia since April 2017, a role he took on after running the bank's operations in Korea for 4 years. Before that, he was the global head of multinationals for HSBC, coordinating the coverage of multinational companies across more than 80 countries. Martin began his career in 1989 with Crédit Commercial de France, which was named HSBC France in 2000. How was my accent then, Martin?
Perfect.
Perfect?
Absolutely perfect. Yeah.
And last but not least, we've got Steve Holmes. Steve is a senior portfolio manager and research strategist for Queensland Investment Corp, one of Australia's biggest money managers with 85 billion Australian dollars under management. QIC is looking to deploy some of that capital in China, where the world's third largest corporate bond market is opening up to foreign buyers. Steve's responsible for managing the QIC Global Credit Income Fund and for research relating to macro credit strategy. He's worked in credit since 1987, starting out with Westpac in New Zealand, and was previously head of European credit research for JP Morgan Asset Management in London and head of Asian credit research at Jardine Fleming Securities in Hong Kong. So we are in good company. We've got a fantastically experienced panel with a tremendous amount of experience in Asia as well to lead us through this discussion. I will be turning to you for questions, and there will be a roving mic, and we will have an audience poll, though not half as controversial as the last one. So don't worry about that. For the past 3 or 4 years, really, pretty much every conversation that we've had about Australian business engagement in Asia has referred to that PwC report, Passing Us By, which I'm sure you've all read in great detail. It paints a pretty stark picture of a lack of engagement in the region. As of 2015, only 9% of Australian businesses were operating in Asia. Only 12% had any experience at all of doing business there, and a startling 65% had no intention of changing their stance. That report also showed that we were just simply falling behind other countries, with Japan doubling and China tripling its investment in Asian nations since 2007. Let me turn to you first, Swati. From your perspective, at EFIC, looking at small and medium enterprises, that have already won export contracts, how are you seeing Australian business engagement in Asia? Is it increasing?
So again, in the context of what an EFIC sees, so I should clarify that we get involved in financing SMEs when the commercial market can't help them out. So we see them after they've had unsuccessful attempts with other people in the market. We're actually seeing an increase, but it's not off a huge base. So if I think in terms of our portfolio of loans, about 22% of our exposure is in Asian markets. And if I think about from the time we've actively started supporting SMEs, which is probably the last 4 years, it has increased over time. And the markets that we're talking about aren't necessarily going to be, just China and India. It will be, Sri Lanka, it will be Thailand, it will be Vietnam. So it'll be a range of markets. And to give it an external perspective, I think we launched today the results from our Australian International Business Survey that we do with Austrade and the Export Council of Australia. And what they do is they survey 713 businesses that are from all different industries and they're all different size. And the interesting thing from the survey is there are some themes that are still quite pertinent, which is, the top markets that exporters look to, particularly first-time exporters, will be markets where people speak English. So, they do tend to be very much the US, the UK, New Zealand. But when we ask them, what are the future markets that are going to be important to you? Well, then it comes down to, again, US as the first, and then China, the UK. But you also tend to fit in Indonesia, Vietnam, and India within the top 5. So I think it's still increasing. The challenge is how do you get even more momentum? Because I'm looking at SME deals that are very small. So we're talking about a very small section of the market. One of the things that we've observed over time is when we support some of the larger entities that are doing major developments in emerging markets, that's when they actually bring along a whole range of SMEs. So that's really important to kind of take them along on that journey.
So it's the top end of town that builds that critical mass.
Absolutely, the top end of town builds that critical mass, and then you get quite a lot of SMEs. So that pool is a lot more impactful than individual SMEs trying to do business in these markets.
So you say that we're improving off a relatively small base.
That's what yes.
And you touched on language. Is that one of the barriers to engagement? And what are some of the other barriers to engagement?
Yes. So language is one of them. So particularly if you're a first-time exporter, the first thing you think about is there a demand for what I want to sell or what I want to provide? So that's obviously the first thing. But the second is language, very much. The other barriers tend to be around, cultural differences, business norms, and just navigating regulatory complexity if it's around a particular product or a good. So I think they're kind of the normal barriers that come into play. And again, when you think about some of these markets, they're not homogenous, right? So even within one country, even if you think about India, it's not homogenous. So trying to work out where they should play, and then if they're an SME, they don't really have the resources to actually do all the due diligence and spend all that money for the small contract that they're wanting to fulfill.
Mark, you're at that top end of town. Like Swati, you've got a terrific insight, a terrific window into the prevailing sentiment amongst Australian businesses. You're in 15 markets in Asia, supporting institutional clients with trade and capital flows. What are your clients telling you about engagement and about barriers to engagement and what they need to see changing before they can rush headlong into the market? Or are you already seeing significant growth since that PwC report came out?
Yeah, I think it has grown, Ed, since the PwC report came out. But it is complex. To Swati, many of Swati's comments I'd completely agree with, because it is complex as you're going in, whether you're a large corporation or a medium-sized one, and you have to find a way to navigate that, and you need to educate yourself. So I think the expectations, when you look at Asia and you see how big the opportunity is, regardless of which country you're looking at, that's compelling. But to access it will take time, and it will take good, thoughtful planning, I think, from not only government here to help, but also many of our customers in building relationships and understanding of the markets. So a lot of the big end of town do have more resources to do that. They can access help. Many of Australian corporations are now or firms are setting up across Asia, and certainly in China. They're legal firms, they're accounting firms. They can help navigate many of the issues that Swati's talking about, and banks like ourselves. So accessing that for the big end of town is easier. They have more resources. When you get into the middle market, I think there's a different approach. They can still access that, but I think it's a longer term approach. We've taken hundreds of our mid-sized customers to Asia over the course of the last 5 years. So we run about 5 tools, if you want a bit of a term, into Asia. We might go to Vietnam, we might go to China regularly, where we bring a number of our customers, might be agricultural customers, might be other types of customers in different sectors, where we take them, introduce them to potential customers in that part of the world, but also to regulators, to firms that can help them, so they can, one, get an idea of the culture, get, two, an idea of the issues that they need to navigate, but three, also to underline the size of the opportunity, but you have to be well organised going in. So I think this is a slow burn for the country, but it's an important one because it's on our doorstep, and no one would argue with the size of the economic opportunities that are there now, but also very much in the future.
Yeah, I might ask Martin to elaborate on that. We're obviously speaking to the converted in this room here, but are Australian businesses missing a trick in Asia currently?
Well, I think first there's been very good progress made. You know, you mentioned the PwC report, which was about 4 years ago, and there has been a good journey covered by Australian exporters. If you look at the numbers, you know, 70% of all Australian goods export to Asia Pacific. So this is a huge number, really, and far, far more than what it used to be 20 years ago or 15 years ago. And within those 70%, about 30% exported to China, so by far the largest destination. So there is absolutely no doubt today that the connectivity between Australia and Asia Pacific is now very strong. With China, with ASEAN. There has been also the very positive impact of the free trade agreement, CHAFTA, with China. You know, since it was signed about 2.5 years ago, plus 25% in the export flows. So it has benefited tremendously. And if we look at the long-term perspective, you know, Asia Pacific is about 30% of the world GDP. It is already the largest economic area, bigger than North America, bigger than the EU. The Asian population is about, I think, 60% of the world population. So there is absolutely no doubt that for Australian exporters, the future is in China.
Yeah. Clearly, HSBC is going all in on its Asia strategy. You know, your new CEO's got a $17 billion investment plan for the region. How does HSBC Australia fit in with that global strategy?
Yeah, we are certainly, you know, the most Asian global bank. We are born in Hong Kong and Shanghai 153 years ago. So China and Asia Pacific has always been critical to HSBC. Still today, we generate about 60-65% of our global profit and revenue from Asia Pacific. So we have a new management team who has decided to continue the strategy, which was a pivot to Asia Pacific, continuing to invest in the region and invest in China, in particular in the Greater Bay Area, where we want to be not only a wholesale bank, but also a very credible retail player, and ASEAN. Where does Australia fit in that context? We are integrally part of Asia Pacific, and we are here to support Australian customers doing business in Asia Pacific and Asian customers, Chinese, ASEAN customers doing business in Australia. So we want to play this connectivity. We want to share our local knowledge of those markets. You know, in many of those countries, we have been there for more than 100 years. As Mark and Swati were saying, local access, local knowledge, local expertise, understanding of the regulation is absolutely critical, and that's what we try to provide our clients with.
You've both mentioned regulation, Swati and you, Martin. You're at the sharp end, Steve, of the regulatory environment with the work that you're doing in China. How do you navigate so much regulatory change in the financial space in China, particularly if you don't have offices on the ground there?
So, look, it is a challenge, and it's something we have to stay on top of. So I think one of the things I've had to do as I've sort of been learning about making investments in Chinese markets is to get a good source of information for regulatory changes that come out. And to be honest, I draw on all the resources I can. So sometimes Bloomberg has alerted me to some things. Shameless plug. No, not really. It's true. I check my Bloomberg, and there's some quite good services that you can sort of link up to for alerts. Our investment banking colleagues, HSBC have a strong presence in that region, and they've got some good analysis as well. A couple of research pieces from ANZ as well have helped me. So, I'm really, and increasingly on the ground as well, like there are Chinese services. But most importantly for us is QIC has a strategic partnership with a massive local firm, Ping An Asset Management. And so I've been working with them for the last 18 months on putting together, basically, facilitating a bond fund or ways to get maybe an access product to help investors actually access the Chinese bond markets, where we've done some of the regulatory work for them. Piece of research I read recently from a guy at Bank of America Merrill Lynch. He'd counted that since the GFC and the Chinese government started sort of some stimulus measures to grow the economy, he counted 443 different regulatory announcements that have been made since then. I think it's probably more closer to 470 or 480 by now, no, 490. So, look, regulatory change is a fact of life in China. And, I think sometimes it's frustrating, but we have to bear in mind that we're dealing with a different mindset. China is still and will be for probably the rest of most of our careers a managed economy. And although there is a plan, they've been quite vocal in their desire and their ultimate aim of opening up the markets. Even as 40 years ago, I think Deng Xiaoping coined what's now become one of my favourite phrases, actually, the idea of crossing the river by feeling the stones. And I think that's very much is what's happening with the opening up of the Chinese market. They can't do a big bang. It would be devastating. So they have to cross the river stone by stone. And sometimes there's currents and turbulence in the river. Sometimes it comes from external forces, like we're seeing at the moment. And that regulatory environment has to change and adapt. Sometimes it's 2 steps forward, then 1 step back. It adds challenge, but it actually also makes it interesting for us. So, I think the important thing is to understand, though, that the general thrust and the ultimate aim is to open up the market, to bring market discipline to pricing mechanisms, ultimately to bring some market discipline to the allocation of capital within China. We're not there yet, so we've got to keep on top of regulation, but I think be sympathetic to what the regulators are trying to achieve.
I'm going to try and tease out quite a nice anecdote you shared with me when we prepped for this panel on the phone a couple of days ago, and you were talking about the importance of that local network that you build up in China, and you had quite an interesting experience where you got a source of information from quite an unusual source.
Oh, yeah, look, it's not that unusual, I think, if you're in China, but look, we talked about the different internets, and WeChat is just a huge and incredibly efficient and really, massively utilised piece of kit. And so I was having lunch with one of our partners over there, or someone from Ping An, and we were just talking about a couple of the regulatory impediments that were still in the way of the Chinese bond market actually being fully recognised by Bloomberg Barclays for their index. So they needed to fix some settlement issues around real-time delivery versus payment, and some questions around how foreigners would be taxed. And it was taking a long time, and so I just asked her, just in the meeting, I was saying, this is a bit frustrating. When are they going to do something about this? And she said, hang on a sec. Tap, 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 tap. We carried on talking over lunch, and by the end of lunch, I had an answer from 2 different regulatory agencies saying, yes, no, we're aware of these issues. We're working on it, and we should have a solution very soon. Thanks for your question. So,
access.
So that's actually another source, is the informal communication networks that we need to build. When China's a people place, and one of the key ways that I've learned to do business there is, it's this person-to-person connection, I think, is where the real strength is. And WeChat helps that, and also just it helps us stay on top of what regulation, where regulation might be heading.
Yeah. That's great insight. Thank you. Let's stay with China. We seem to be potentially on the brink of a full-blown trade war if Sally Old and JP Morgan are right, and some of the things that we've heard from Washington, both on and off the record over the last few days. Martin, China is such a huge focus for HSBC. The one concern that you pick up in analyst research notes on HSBC's business has been whether a trade war would derail HSBC's growth story in China. What impact do you see, and how do you insulate yourself from any fallout?
Well, if we step back one second and look at the long-term trends, there is no doubt that there has been a correlation between the global GDP growth and trade growth. And when we have seen some correction post-GFC, for example, trade has declined as well. So strong correlation. At HSBC, we are the largest global trade bank, and we are very much advocates and supporters of trade and trade flows, and supporter of free trade agreements wherever we can. So the trade tensions, are a concern, definitely. Because if they turn into a full trade war, well, it's not yet there, but if it does happen, it may have some impact on the global economy. Now, we will need to look at it in a very careful manner, because the impact will not be the same everywhere. Yes, there may be a negative global impact, but we may see also some differentiated consequences. I would think that if trade barriers rise, we will see more intra-regional trade growing, more Asia intra-regional trade in particular. I think
different trade corridors open.
Different trade corridors, because the supply chains will change, and we are seeing them changing already. We are seeing in particular some ASEAN countries becoming more attractive as manufacturing centers, in a global environment. So it is possible that we see some countries benefiting, and some others probably losing a bit. Now, in an Asian context, I think it's very likely that we see more flows between countries. And I was very interested to see the poll previously about what is the perception from an Australian perspective of this risk, and to find it reasonably moderate, And I think Australia is well placed in that context. Well placed because having a free trade agreement with a large number of countries, having a very good relationship with a large number of countries, including those involved in those trade tension, and very well positioned to continue to expand its trade flows.
Swati, are you optimistic as well for the exporters that you deal with, that multiple trade agreements that we've got bilaterally will help insulate us from some of this shock?
Well, we're certainly seeing, just leading on from the ASEAN Australia Special Summit earlier in the year, we certainly saw a lot of interest from exporters around those markets. So I'm actually quite optimistic. And if I look at my portfolio, we do have quite a lot of exposure to those ASEAN markets. So there is an alternative, but I can't look into my crystal ball and say whether that alternative is enough to balance out whatever else might happen.
And Mark, what are your clients telling you? What are their concerns that they're voicing to you, or are they not voicing concerns? Are they pretty bullish about their opportunities in a sort of broader non-China environment?
I think they share similar views to what Martin's expressed, to be quite frank, and we talk to them obviously, and we do our own research, and I think it's fair to say the people, Australian and New Zealand customers who are dealing into Asia, into China, and the products that they're supplying would be saying they're cautious about the economic impact globally should a full trade war occur, because things will slow, there is no doubt about that, and that'll have some flow-on effects in an economic sense. But for the underlying trade and the products that we're supplying into the region, we're pretty well placed. I mean, it's agriculture, it's hard commodities, it's tourism, it's other services like education. And, we're well placed, we have good relationships, and they feel that will continue. So that corridor back China to US would probably be a different answer if you're playing in that corridor. But the corridors that certainly our customers are playing in, that's what we are focused on, Australia, New Zealand, Asia, and Asia back into Australia, New Zealand. We feel that will stand through these issues. It would be their feeling, and that's what we would support as well.
And does that optimism vary depending on what sector your clients are working in? You're saying, you're in resources, financial services, tech, agribusiness. Is it uniform, or do we...
Tech, I would say, would probably be a little bit more muddied, I would say. But certainly on the resources sector and agricultural sector, I mean, there's such massive opportunity there. And should things escalate between China and the US, I think, if anything, it opens up more opportunity in those sectors for us and our customers here. So I think they'd be more optimistic on it, but cautious simply because it's very difficult to know how this will play out over time, and how hard it gets, or how really difficult it gets between the two countries. And the flow-on effect too, there will be a sharp. We would expect. I think you talked about 1% drop to GDP. I think that would occur in China, and then that would definitely flow through Asia. So I think you just need to be cautious and be careful about who you're dealing with, where, if this does come through.
Steve, you've been to China 3 times in the past year. Anecdotally, what's been the reaction of the Chinese that you're doing business with to this fairly relentless attack that's coming out of Washington as the skirmish escalates toward a war? How are they coping? How are they making sense of this?
I think I'll echo some of the comments that Sally made in the earlier session, actually. So initially at a high level, for example, Ping An's own economics team, I think the impact of the trade war currently is pretty small, maybe 0.2% of GDP. And that's kind of where, I guess, some of the trade impacts are offset by local stimulus. But I guess, like Sally said, that's kind of at the level of the macroeconomy and using models and pulling the levers within your models. What I noticed, particularly over the journey of the 3 different trips I took, is the change in mindset of people who do business in China. And particularly, was it a month ago, this confusion, and I don't think fear is the right word, but certainly just like concern. It sort of reminded me of people who felt like they were the victims of bullying at the moment. Now, I think we recognise, as was mentioned earlier, that some of the points that are being raised in terms of a trade dispute are valid, and I think even people in China would privately agree with that. But they've noticed that China has reached out and tried to make a few steps towards the American position, and every time they do that, it seems that maybe it's Trump's negotiating tactic, his art of the deal, is to actually step back further rather than meeting them part way. So, they're feeling a little dazed and confused. And my concern, and I think it sort of came through in the PMIs that came out yesterday, the sentiment indicators, it's very hard to make an investment decision, to hire someone, to build a new factory, when you don't really understand the field you're playing in at the moment. So this is new, and they don't quite know how to process the reaction function that they're seeing out of particularly the US and the way they're handling that trade. So what that can mean, I think, is the sentiment side could actually end up having a bigger effect on the Chinese economy than what's currently coming through. I would notice one thing, though, to point out from the PMIs yesterday is that most sectors were down, but there was one which was much more optimistic this time. It was the construction sector. China has started to reactivate the internal mechanism it uses, to help stimulate some growth. I might just add that could initially raise some concerns, because we've talked about China walking this delicate balance between trying to deleverage and managing the size of the government and the economy. But turns out that most of the money that's being spent at the moment is actually money that was already in the budget for this year. So local governments were kind of said, give us your budget, right, you can go and build that project, whatever. But we're deleveraging, so don't borrow too much money and just take your time. So in the first half of the year, our economist colleagues at Ping An noticed a big undershoot in terms of local government infrastructure spending. What's happened now, I guess maybe more by good luck than good judgment, they've given themselves an opportunity to add some stimulus without actually adding any more fuel to the budgetary fire by just spending what they already said they were going to do. So we're starting to see that ramp up in the second half of the year. I think the chances are they actually won't spend the full budget for this year. So we will see a deleveraging of China, even though there is some form of fiscal stimulus now coming through. So, and as I said, the construction centre was actually optimistic. Really high PMI out of the construction sector yesterday.
Let's throw it out to the audience. We're about the halfway mark of our panel, so let's see if we have any questions from you lot out there, if we've got a roving mic. Yes, gentlemen here. Please do introduce yourselves and say where you're from.
Hi, Mike Cannon-Brooks from Advance. I've spent a lot of my life. I've lived for 15 years in Asia and 8 up in Shanghai. And one of the things, getting back a little bit to the discussion this morning, was how do we get the big end of town, how do we get the big end of town to have more business engagement with Asia, in particular China, but also the whole of Asia. And it seems to me if you take China, one of the issues is that you need to take a 10-year view on China. And when we're now on the American quarterly earnings treadmill, it's very hard to get investors, and you probably have a better view than I would, about taking a 10-year view. But I can guarantee, unless you take a 10-year view, you look at where the success and where people have drawn back. So one of the things is how we get the companies to engage more, given the opportunities that you've all talked about. The second one, and it gets back to Advance, is that we need to get more people on Australian boards and back in Australia that have overseas experience, especially Asian experience. And all of us have our stories on that. We in Advance see dozens of people coming back, going into interviews, wanting to become non-executive directors, and I know one had 23 years of global experience, especially within Asia, huge experience. And the questions after a couple of polite ones is, what do you last do here in Australia? And so, I mean, I would love to see the time when every ASX 200 company had somebody with Asian experience living and working there on their board, just to give that different perspective. We love to look from Australia out. We've got to start learning to look from the rest of the world in. So I'd love any of the panel's views about that.
I might start. I worked for Mike many years ago at Citibank, so I don't know if you remember that, Mike, but so... That's right, yes. Daryl, I still see Daryl and Steve Anthony and all of them. There's that sort of alumni is there. Look, we've wrestled with this as a bank because the discussion with analysts, particularly about our Asian strategy, as you would have seen through the last 10 years, has been difficult. We have a large percentage of international investors on our share register, which of the major banks, ours would be much larger of international investors on our share register. And so when you look at, in answering the question, I think telling the story better, getting the right experience on the board, and also, from our perspective, going in and doing and executing on our strategy was really important. I think we did that really well early, to be honest. Then we changed the strategy and started to go in, and this happens, we see this with many of our customers. They'll move into an area which maybe is not as lucrative. For us, that was in retail banking. We were never going to win that. If I'd come and asked you, I'm sure you would have told us that. But it was a time when it was right at that moment, because if you remember at the GFC, it was all about liquidity. and you needed liquidity. As we were expanding in Asia and we were growing very aggressively in a wholesale bank sense there, we felt we needed liquidity, and therefore we moved into, and we got a cheap asset in a retail bank that we bought there. In reality, we were never going to win in that strategy. And that's when I felt that the strategy and execution for us shifted, and we started to lose some of the support that we did have around the strategy from analysts and in some cases investors. So I think it's a combination of being really clear about where you can play and how well you can play and where and how you can win, and executing well into that and telling that story consistently in a simple manner. We lost a little bit of our way on that. But I completely agree with you around having more directors on Australian companies that have that international experience, particularly the Asian experience, because I think that'll help navigate some of these issues that we see. The quarterly returns is always an issue when you're thinking a 10-year strategy. We've been in Tokyo 50 years, Indonesia 45. We've been in Asia a long time. But it does take time to get the returns right and the decisions right.
Are we too insular in Australia? I mean, obviously this panel doesn't reflect any insularity at all with your vast wealth of experience across multiple different geographic regions. But do you come across that? Do you come across boards, as he was saying, that simply are looking for Australian experience and don't seem to be valuing the experience that people have picked up in Asia?
I would say yes. I think that if you look around at just the structure of the boards, I think that would support the proposition that Mike's put forward, and so I think we are. I think we see as I said earlier. I think everyone sees the opportunity. Not quite sure how to grasp it. Maybe not as necessarily having the courage to go and grasp it, because it takes. If you're sitting there as a CEO or chairman, which tend to be in 7-year cycles in the country. And if you're going to get returns in 10, it's quite courageous to say, go ahead and do that. And I think that, therefore, you need to think about business the way the Chinese do, to be honest. It's a much longer term position in 5 years, 5-year, journeys, 5-year parts of journeys in a long-term game. But we're not really geared that way. So I think it's true that we don't have enough experience and probably not structured in a way where we give executives the opportunity to build the business over a long period. That would be my view.
Steve, sorry, I'll come to you in a second, Martin. Steve, this idea of having to take the long view, that's something that you'd be used to at QIC, right? How many years have you put into the strategy of joining Bond Connect and setting up a China bond fund? When do you see that bearing fruit?
Well, QIC's kind of commitment to China has been going for at least 7 years. So 7 years ago, we actually hired Vicky Wei, who's a Chinese lady who rather than having an office there, we kind of have a virtual office. Vicky sits on my floor, but she spends most of her life in China and has been building those relationships for 7 years. QIC's talked about Asia before that. But again, for us, I guess the business is different. We're an institutional asset manager. We don't have any of our money that we invest. We invest some on behalf of the Queensland government, but we're looking to find other assets for clients. So our interest in Asia, we have property assets and infrastructure assets that we manage that Chinese investors would like to participate in. So part of Vicky's role is to generate those kind of opportunities. But on the flip side, we also see tremendous opportunity to invest in China. And so that strategy, particularly around the bond fund, I've been working on it now for nearly 2 years. I manage a global credit fund, and it seemed ludicrous to me that here I am managing a global fund, yet we've got very little exposure to the second largest economy in the world and the third largest bond market in the world. And we're having to do all the work, right? Because it's such a big part of our business here in Australia and a lot of the businesses that we invest in. We have a team of economists. They're always reporting on the outlook for China, and we had very few levers that we could use to pull to express that view and make money for clients. So we've been working with Ping An now nearly for 2 years just to try and develop a bond fund that I could then invest in through my global credit fund. I'm not ready to invest in Chinese companies onshore domestically. I looked at Chinese companies in US dollars, and what I find is that's driven more by decisions the Fed makes, or else US investors' view of risk, because China is seen as an emerging market. So when risk appetite is low, people tend to sell their Chinese bonds regardless of what China is doing to stimulate. So China is actually a tremendous opportunity because it's a diversifier. It beats to its own drum in terms of its economic cycle, and really it's generally quite different to what's going on in the rest of the world. But it's been very difficult to access that. The Chinese have moved towards us. They've created some more regulatory change. They've created Bond Connect and so forth to open it up, to make it easier. I'll say it's still not easy, but easier to access the Chinese bond market. And yeah, you know, I think we're probably 6 months to a year away from launching our product still. So for me, it'll be a 3-year journey just to get started.
Martin, you wanted to jump in?
Yeah, just a couple of comments on the gentleman's observation. You know, when I arrived in Australia 18 months ago, I heard about this concept of tyranny of distance and insularity. Yes, there is a tyranny of distance, obviously. And but when you look at the Australian economy, it was mentioned several times today, 27 years of consecutive growth. It's a very profitable market on a domestic basis, and probably because partially of distance and insularity. So that means that when it comes to internationalization, it is a diversification. It is usually dilutive in terms of return. It is more risk that you have to take on the balance sheet. So you need to be bold and courageous to do it, and to have the long-term strategy to be able then to face what is not tyranny of distance, but tyranny of the quarterly results, where you have to explain, analysts, every 3 months, you know, why you are making less money than in your home market in your diversification. So this is very specific to Australia.
That is a really important comment. I think Martin hit it on the head there. I think that the economy, because we've had such a wonderful run for a long period of time, you could argue that complacency comes with that. And therefore, and why would you stray from? And it's a fair, you know, the analysts have a fair view. Why, and the investors, why would you move away from that? But I think we're in a different world now. There's more challenges, I think, in Australia. Certainly in the banking sector, we see it that way. And so I think you've got to have a broader view. And I think that diversification may play out more in the economy going forward, and what you do in big companies than maybe it has in the past.
I mean, I think. I agree with what you've said, Martin, and I think the perspective is, you know, what is the long-term vision? And I think that's something you don't see organisations and their boards think about. You know, you don't really see that sense, which I think is the difference between Australia and Asia, where they have a very long-term view. And they're planning for that long-term view.
Great question, Mike. Thanks. Any other questions from the floor?
Hello, Heather Gilmore from Pearson Education. Thank you. There's been a lot of talk, obviously, of India and China. I'm interested in other countries as well, particularly opportunities for joint ventures in, say, Vietnam, Japan or Malaysia. Could you comment on that, please?
Maybe a few comments. So. Vietnam, Indonesia, Malaysia, definitely we are very bullish about the potential in those countries. Absolutely no doubt. So when you look at ASEAN, this is about I think 660 million people. So if you look at the consolidated GDP of ASEAN, that would put it more or less at the 5th or 6th largest economy globally. So there is a huge potential. And then on the top of that, you have very strong growth rates in Vietnam, Philippines. So they are very attractive economies and markets. Some of them are more difficult than others in terms of doing business. But there is no doubt that you cannot have an Asian strategy without today having an ASEAN strategy, very clearly. Now, joint ventures, I can only comment for HSBC. We prefer to build our own business organically, sometimes inorganically, but in most Asian countries it has been organic, and we. Those markets are difficult, so you need to find the right balance between local knowledge, local connectivity with the right partners, but also being able to roll out really the strategy you want to roll out, and in a way which is consistent with your global strategy, your global organization. And when it comes to banking, this is particularly important because we are in a heavily regulated business and in a risky business, and our business is managing risk, so we want to do it in a way we feel comfortable, really. And that's not always possible in the context of a joint venture.
Let's use that question, actually, before you answer, Mark, as a really nice segue, actually, into broadening out the conversation away from China and looking at other opportunities within Asia. So let's get our devices ready, and we'll have the final audience poll of the afternoon. This question is, which country in the region presents the biggest opportunity for Australian business? And the options we have are India, Indonesia, China, Japan, and Korea. So we'll let those numbers settle a little bit, and then we'll probably go to Mark next to continue answering your question. And I don't want to preempt your answer, but as those numbers are sort of bouncing around a little bit, Anna Green, the Philippine CEO of ANZ, wrote a really nice essay exploring the ASEAN region and questioning whether it could be this decade's China. She notes that it's got a population of more than 630 million people, 3.4% of the world's GDP, and growing. Let's see the results. India 17, Indonesia 16, China 58. So that's why we spent so much time talking about China, obviously. But Mark, where else are you seeing the opportunities then?
Look, we just picking up on the joint venture piece first. We've had good ones, and we've had ones that are a bit more difficult. And so I think choice of the joint venture partner is really, really important. And, so we see that'd be the only piece of advice. A lot of research, a lot of getting to understand culturally where there's a really good alignment, and building that trust over a period of time before any commitment, I think. And that's what we'd say as a bank, but with the number of our customers that have also gone in and done joint ventures, the ones that have been successful are the ones that have really done the research, got to know the partners, and spent a lot of time with them to ensure that there is good alignment of not only economic opportunity, but also the alignment around the cultural aspects of how you run your businesses. With Vietnam, we see great opportunities. Indonesia, we see great opportunities. We think that those markets will continue to grow. Indonesia is now growing about 5%, and that's pretty stable and long-term. India at 7%. Vietnam, I'm not sure off the top of my head, is about 8 or 9, I think. So great opportunities there. But again, it's access to the market and choice of partner. If you're going to be successful, you have to do that research over a period of time, would be my sense. Did you want me to comment on this, the poll, or is...
Yeah, if anyone's got any views on those countries. Why didn't we ask you about India?
Yep.
Greg made the nice commentary picking up on Ninan's comments about the growth of the agriculture sector in India and potentially suggesting that it might not be the export market that we'd hoped it would be for Australian farmers. What's your sense of the Indian opportunities in the agribusiness sector?
I think that they'll be there. I wouldn't be too concerned if I was in agriculture here in Australia, or from an Australian perspective. What we can produce, there is so much more demand in the region than the supply that we can produce out of this country. We've got very high quality produce. Our farmers are getting significantly better on yield, provenance and quality. And I think if we stick to those competitive advantages, which is well written about, particularly in China, I think that gives us an advantage to be able to export quality at a premium, regardless of which country, is the way I'd respond to it. They may see that as another big market, and I'm sure it will be for some of these products, but I think ultimately there's going to be significantly more demand than there is supply coming out of Australia. So you may have a choice, is the way I'd say it.
We've probably got time for one more question from the audience. You'll probably be aware of the flurry of activity now in the room as the media start setting up their cameras for the Prime Minister. Do we have another question from the floor? Yes.
Just Patrick Hutchinson, Australian Meat Industry Council, CEO. Just following on from that question, obviously I represent the largest agricultural exporters in the country, and the key consideration that we have, certainly in ASEAN, is access. And I'd be keen to hear from others about what that is. I mean, there in some parts we might even give up on Malaysia altogether, because essentially there is no beef processing facility in Queensland now accredited for Malaysia because of halal issues. So we've seen Indonesia knocking back $100 million businesses in regards to, say, rendering products. So I think that we tend to, not overblow, but I think we tend to really push hard in ASEAN and in a couple of key areas when essentially we've got non-tariff measures that are affecting us in a great deal. And our research is showing we've now ticked over 3 billion globally that we are not getting access to because of non-tariff measures. And I'd be pretty keen to hear at an economic level where you think that's going to go, because I'm fighting tooth and nail around that, as each prospective government's doing, and it's actually getting worse, not better.
How do you see the outlook in Malaysia? Are you doing much business there? And then Swati, do you get similar stories from other exporters trying to do business in Malaysia?
Not really. I mean, we actually haven't had too many exporters in recent times talk to us about Malaysia. Most of the stories tend to be around Thailand or Indonesia, from our point of view.
Regulatory barriers?
Oh, no, not at all, in terms of people want to talk about what they can do in those markets.
Look, the only thing we don't do a lot into Malaysia either. We've got an investment in a bank there, and we've got a rep office there separate to that. We don't tend to have a lot of our customers doing a lot of business into Malaysia. On the other markets, I think it gets down to how do we help, how do we as a country help you get there? And I think that gets down to the trade agreements that we've got, the negotiations of that, the regulatory, trying to clear the regulatory hurdles that happen there. And I think that, the Department of Foreign Affairs and our trade ministers, I think, have done a terrific job in a lot of instances with the free trade agreements that we've signed and the partnerships agreement we're now getting into with Indonesia. We just have to keep continue down that road, because there's no doubt there is a significant opportunity there. And this is what we see all the time, even when you're dealing into China. The regulatory environment doesn't make it easy, regardless of which sector you're in. In fact, if you go into China, if you're going into one province to another, it can be different, significantly different. And so it's hard to navigate. So I think we just can't give up, is the point I would make. We need to continue to say that that's where our growth opportunities are, and we need to talk more about those issues and have them discussed and then hopefully fixed.
Well, that's great. I think it's probably time we wrapped up today's final panel. Thank you so much for joining us.